does have some overlap with Russia's commodity exports.
All right, that's some important global opinion on the geopolitical tensions that we're seeing and what it could mean for the markets. We also have an interview lined up. Aashish Somaiyaa, CEO of White Oak Capital Management, joins us now to discuss the fundamentals of this market and the way forward. Aashish, good morning and thanks a lot for joining us. This is Pavitra. You know, these geopolitical tensions have really been dominating. Our markets have been seeing wild swings based on all of the news flow that's coming out of Eastern Europe. But, you know, at a time like this, when we've already seen crude surge like this, do you think that a lot of the bad news is already priced in and maybe we won't see too much of a fall from here, or do you think there's a much bigger risk that we could see?
Yeah, thanks for having me, Pavitra. On your question, I'd say that, look, there was a very sharp fall on Thursday and then an equally sharp recovery on Friday. I would say that, I would hesitate to declare any victories. Even this morning, there was a sharp fall and now, we are witnessing some kind of a recovery. But I think when there is extreme volatility, it only means that the market is kind of struggling to price in a variety of unknowns. And there are many unknowns which still remain to be unknowns, right? I think one of your interviewees in the earlier panel mentioned that there could be spillover risks from the way Russia is being isolated or the way they are seeing, financial market reactions. So from that perspective, I think this is not a time to draw any definitive conclusions. I think one should just wait and watch for the evolving scenario. And while it's very difficult to forecast any of these macros, the least one can say is, watch for the next few days and see how things play out. Too early to say that the worst is behind. There could be a lot of things which will evolve in the coming days.
So Aashish, would the advice be to retail investors to buy the dip or just still stay away?
No, I think these are times when, it's better. Look, the question needs to be answered for two sets of people. One is people who are already invested. And, bulk of us are already invested because as we know, let us say, for example, the mutual fund industry, 17 to 18 lakh crores in equity, and the monthly flow is say 11,000 crores in SIPs and another 20,000 crores gross. So for anybody, whether it is you, me, or the public at large, for everybody, the stock is a much bigger thing than the flow. So the question needs to be answered. Generally, people discuss this for the flow. For the flow, it's very easy to say that, over the next 3 to 6 months, volatility is a friend. So over the next 3 to 6 months, you keep entering. But the more difficult question is for the people who are already invested. And I think, they've already, so clearly everybody has missed the peak, right? So there's no way you're going to get the peak now. You're already down about say 10 to 15% from the peak, and at a stock level, portfolio levels, that number could vary. So no point reacting now, but at the same time, I don't think that people should be averaging or jumping in. I think the idea is that for people who are incrementally allocating, it's just good to spread out. But for people who are already invested, sometimes people say that, okay, let us sell this bunch of stocks and let's buy another bunch of stocks and let's kind of, rejig the portfolio, rebalance the portfolio. I think all those things are very, very difficult amidst these evolving circumstances. And I think sometimes, not for long, but at least for the next few days, maybe it's better to do nothing.
Hi, Aashish. Morning. I would tend to agree with you that for the time being, at least, it would be preferable to do nothing, and especially when it comes at the back of these 2 years where we've seen a global pandemic, a war, and, any number of smaller events in between. Perhaps this is a time to take stock of what we've learned. So as a fund manager, investor, what would you say has been the biggest learning of the last 1.5, 2 years?
Yeah, I think a couple of things have happened. One thing which you cannot take away is that in the last few quarters, look at it this way, even if you see the pandemic or even if you see the last few quarters, what I've seen is that increasingly local conditions or local performance of companies, of the economy has definitely surprised on the positive. And right now, as we speak, our market seems to be getting cheaper for reasons which are actually beyond our market. Of course, the impact for us is oil that has been well captured, doesn't need me to say that. But it also stands to reason that because of better external conditions, because of better external macros, our ability to withstand slightly higher oil prices, is better than what it used to be, say, 5 years or 10 years back. Having said that, oil and some of these external disturbances definitely expose us to turbulence. But on the whole, it won't be wrong to say that our market is becoming cheaper and cheaper purely because of things which are beyond our borders at this point in time. So from that perspective, anytime you have seen our market becoming cheaper because of, say, foreigners selling or because of external conditions, eventually it is always followed by a significant recovery. And as far as foreign portfolio investors are concerned, they work on an allocation basis. Right now, there is probably a global risk off, and when that stabilizes, you will see them buying as much or more than what they've exited in the last few months. So from that perspective, one would remain constructive as to what we are likely to witness in the coming months. Maybe probably a significant recovery in the markets is what we deserve given purely our fundamentals. But the key point is that only when we are going through the situation, when market is trying to price too many unknowns, and that is what is manifested in very high volatility. It's very unusual for market to go 3% up and 3% down subsequent days or even intraday. So it's very obvious that we are trying to price in too many unknowns and better not to jump to any conclusions, right?
Aashish, I know you said that this is a time and it's probably better not to do anything, in the equity space. But do you think at a time like this, maybe you should just reconsider your entire asset allocation, move money to maybe a safer asset like gold, something which is not as volatile, maybe to real estate? Would that make sense?
Yeah, so see, I would say that these are probably not the times to go about rebalancing. The reason is, see, these are always the times when you learn or when you realize that, oh, well, yes, asset allocation matters a lot. But now that the horse has bolted, maybe today, if you say that, okay, let me reduce equity and let me start buying gold, you might regret it 3 months or 6 months later. So I'm not saying that you should go the whole hog and increase your equity exposure. Just wait this volatility out. But at the same time, there are two things to look at. At one level, I can say that it's always the right time to have an asset allocated portfolio. So there's nothing wrong in ensuring that your portfolio has asset allocation in line with your return expectations and your risk tolerance. So that's the fundamental. But if you are going to change your asset allocation and revisit your asset allocation purely based on what has happened in the last 3-4 days, then I don't think that that's a long-lasting learning that one is actually going to go through. So you need a well-balanced portfolio or an asset allocated portfolio well before you get into any event. And most of these events are unknown. So the point is that if you go to fundamentals after the event has already happened, you might actually regret. So the thing is, keep an asset allocated portfolio at all times on a sustainable basis. But no point reacting just now because equity is down and gold is up. I think that will be very, very tactical or very, very short-term kind of behavior. Once things stabilize, draw the learnings, and then, revisit your asset allocation and then stick with it.
Consistency is the key. Thank you very much, Aashish, for joining in. We'll slip into a very short break. We'll come back and discuss what's buzzing in commodities. Many